So what do the facts actually tell us? Does the stock market tend to do better under a Republican president or a Democratic president? And more importantly, what does it mean for your investment strategy in retirement planning? And in today's video, I'm just going to share with you the facts. My channel is not political. My only goal here is to help you make the best decision for yourself. So we're just going to look at the facts. And it turns out the facts for that question are super hard to find, but I was able to uncover it for you. So let's jump in and start with a more common question. How does the stock market do during an election year? And towards the end of the video, as we build this base, I'll be able to share with you how it does by presidential party. So let's jump in. A really common way to look at this is to ask the question, how does the stock market do in an election year? And a lot of folks think, well, the stock market does really well because everybody's trying to get elected, so they want their constituents, they want you and I to be happy. And it turns out that's right, but it's not the whole story. It's not the best of the 4 years, it's the second best. So it has the stock market during an election year, over 80% of the time is positive. And that's the second best. But what year is the best of the 4 years? Well, in the first year of a new presidency, the stock market's up less than 60% of the time. It's 57% up, and 43% of the time it's down. That's the worst year is the first year. The second year is the second worst year. It's 2/3 of the time, 65% of the time it's up. But a little over 1/3 of the time, 35%, it's down. Turns out that the best year of that 4-year presidential cycle is the third year, not the fourth year, where it's up over 90% of the time. Okay, so now let's start to look at how does the stock market do with Republicans and Democrats. And we're going to go all the way back to 1928. And I'm just going to scroll through this. You can stop it at any time. But obviously the blue rows are for Democrats, the red rows are for Republicans. And you can see here, it starts with Herbert Hoover, then it goes to Roosevelt, then it goes to Truman and Eisenhower, Kennedy and Johnson, Nixon and Carter, Reagan, and then H.W. Bush, then Bill Clinton, then George W. Bush, then Barack Obama, and then the last table that this data has is former President Trump's first year. So this is just election year results. Now, I think it's important. I do want to thank the source of this, Morgan Stanley, but I think it's important to look at not just the election years, but let's look at just overall. And there's going to be something here for everybody to like, and there's going to be something here for everybody to not like, regardless of your political leanings. So if we just look at the election year, and I think it's more important to look at all 4 years, but if we just look at the election years, overall, all election years, the stock markets, the S&P 500 has done well. And this is also according to Morgan Stanley. So all election years, the stock market's done a little over 11% per year. Those are really, really strong numbers. So the year a Democrat was elected, stock market did worse, a little under 8%, 7.6%. The year a Republican was elected, it's actually over double that. It's 15.3%. But hang with me, like I said, I'm not political in this channel, and my goal is to give you the data. So what we find from an election year, going back from 1928 to 2016, is the election year when a Republican is elected, the stock market has done better. But that's only 25% of the time, right? Presidential elections are only 1 out of 4 years. So this is what it looks like over time, going back to that that same time period. If you had invested $10,000 back in 1926, you'd have over $100,000 in August 31st of 2020, and you can see how that has gone up over time. Again, blue, obviously, Democrats, red is for Republicans, right? Overall, though, the chart goes from lower left to upper right. What happens if you were to only invest, let's say that you're a Republican and you only want to invest when a Republican is president, or let's say you're a Democrat and you only want to be invested when a Democrat was president. Well, like I said, there's something here for everybody. So if you go back to 1950 and you go to March 28th of 2024, if you're a Republican and only stayed invested when a Republican was president, going back to 1950, and the rest of the time you stayed in cash, your $10,000 would have increased by eightfold. You'd have almost eightfold. You'd have almost $80,000. But what if you did the same thing? You only stayed invested if you're a Democrat, when a Democrat was president for their 4 years and then went to cash. Turns out you'd have a little over 400,000. So again, there's something here for everybody to like, and there's something here for everybody to not like. So, and I want to thank, I was finally able to find some of this data by a source called ycharts.com. I thought I was going to have to build this for this video. Unfortunately, ycharts.com came out with a report that shows this data. It's a tool that I use. I'm not sponsored by ycharts, but I am very grateful that they did this. Let's look at the S&P 500. If you only invested during Republican presidencies, what's that number annualized? Turns out it's 2.8%. And remember, if you just invested in the election year, for the Republicans, it was about double. It was a little over double what the Democratic return got just for the election year. But what about over their full 4-year cycle? Well, in this case, the Democrats, instead of that 2.8% return with Republicans, the Democrats don't double what the Republicans had, but they did better. It's 5.11% annualized return. And if you look at that over all presidencies for all 4-year terms, it's a little over 8% since 1950. Okay, but now let's look at this, because all presidential terms are not created equally. There's also what's going on with Congress. Is Congress split? Do we have a Democratic Congress and a Republican Senate, or is it totally controlled by one party or the other? That's what this next chart by ycharts.com looked like. So a Democratic president, 1950 to 2023, again, slightly different length of time than the previous chart. But you can see the party, the Democratic president, does even better when there's a split party. So when it's both houses, Democratic, it's 8.72%. But it's almost double when there's a Democratic president, but the houses are split. Senate and Congress are split. And a Democratic president with Republicans in control of Congress and Senate does almost as well as a split house at 14.5%. So if we look at the Republican president, if the Republican president has a Democratic House and a Senate, a little better than 1% a year. If a Republican president has a split House, again, this is the highest return, is with a split House, with regardless of which party, right? So the divided House is 12.2%. And if it's a Republican president with a Republican Congress and Senate, it's 11.7. So again, there's something here for everybody to like and something here for everybody to dislike. But one of the things I find interesting is having a split house, one party controlling Congress and the other party controlling the Senate, regardless of who's president, results in the highest return in the stock market. So now I want to go back and after we go over this chart, I'm going to share what does this mean for you and what does it mean for your retirement planning. So I want to go back to that chart again where we looked at 1950 to March 28th of 2024. And if you just invested during Republican presidential years and it went to cash the other time, or just invested for Democrats, again, those numbers are just under $80,000, starting with $10,000, or a little over $400,000. But look what happens if you leave your money in the market, regardless of whether there's a Republican or a Democratic president. Instead of having 80,000 or instead of having 405,000, you have over $3 million. So what does that mean? I think this is a wake-up call for all of us. And what it means is have a good long-term plan. Sometimes your guy's going to win, guy or gal. Sometimes your guy or gal's going to win. Sometimes somebody else's person's going to win. But over time, we as Americans collectively continue to find ways to do things better, faster, and cheaper. And what that means is earnings continue to grow for these companies. Their profits continue to grow. And over time, if you have earnings and profitability continuing to grow, historically, the stock market eventually realizes that. Is it perfect? No. Is the split between what corporations get, what percent corporations and shareholders get of the profits, what percent the super wealthy get of the profits versus the workers, is that fair? You know, that's for a political channel. Is that, I can say that the income inequality continues to grow. So looking at that and coming up with a solution, whether you're a Republican or a Democrat, I think is important for a country that prides itself on being built on the middle class. I think having been fortunate and been able to travel all over the world, one of the things that I think makes America special is having a broad, a deep, and a healthy middle class. In many countries, there's just very, very poor and less than 1% very, very rich. I think one of the things that makes our country special is we have a healthy middle class. And I think anything we can do to support that is a good thing. So from an investment standpoint, this chart here shows not just the importance of your person winning, whether you're Republican or Democrat, but staying invested, having a long-term allocation, and staying invested for the long term. Because our best friend is time. If we look at stock market returns in any one day, it's slightly better than a coin toss. What percent of the years are going to be positive and negative? If we look at it over 3 years, the odds become more in our favor. Over 5 years, more in our favor. And certainly over 20 years, the odds become more in our favor that we're going to get a positive return rather than a negative return. So what does it mean for your retirement planning? First off, none of this is financial advice. I don't know your situation, but I did want to share the data so that you can make the decision that's right for you. And I would encourage you to work with a financial planner that's a fiduciary to you 100% of the time. My personal takeaway from this is it shows the importance of having a well thought out asset allocation that I can stick with over time. And if I can do that, my retirement savings, my retirement situation, I think the odds of me being where I want to be is much higher. And that's why I think we want to make good financial decisions. I'm not so much interested in beating the market, although that would be nice. But if I can consistently make good financial decisions, that's going to be very helpful for me. And one of the things to make good financial decisions is to have a feel for where you are. And that's why I made this video here, why you're likely richer than what you think you are. You're likely doing much better than you think you are. That's why I made this video. I look forward to seeing you in there. Thanks for watching this one.